Hi, Matthew here and welcome to another video. So in this video we're going to discuss all things relating to operating as a landlord in a buy-to-let limited company. Should you incorporate? Should you operate in a limited company structure? And what is the optimum way to go about that? Now when it comes to buy-to-let, you're always a landlord, but you can either be just a property owner or you can be a business owner. There is of course no one size fits all for this consideration. Everyone's circumstances are different. You may, for example, be a accidental landlord with one buy-to-let property. You may plan on selling in the near to medium future, and quite frankly couldn't be bothered with incorporating and all the additional admin and the associated costs with that. You may also have made your peace with the tax disadvantages. For example, section 24 that was introduced in 2017, where as a sole trader or a partnership you cannot offset your mortgage interest costs against your rental profits. If that is you and you're okay with that, then incorporation probably isn't right for you anyway. But if you have the intention of operating the ownership of buy-to-let properties as a business, then you do need to be a business owner. And the correct way to do that as a buy-to-let landlord is to either incorporate your existing portfolio. So you may be operating as a sole trader at the moment or a partnership. So you'd incorporate your existing properties into a new limited buy-to-let structure. Or if you're fortunate enough, you may be in a position to start with the correct structure from day one. If you are still unsure, then there's two tax-related considerations to be aware of. The first is the capital gains liability that will be created as you incorporate any existing properties into the new buy-to-let limited company. Effectively, you will have to sell those properties to the new company. As you incorporate, you're crystallizing any gains. However, fear not, the CGT can most likely be deferred anyway. You can qualify for what's called incorporation relief. You qualify for this by, as you incorporate and you set about running the new buy-to-let limited company, as long as you undertake a significant portion of the day-to-day running of the business, then you will qualify for this incorporation relief. The new business needs to be seen as a legitimate property rental business that you're significantly involved with. Now, if you do qualify, the CGT can be deferred to such a time when the shares in the new limited company are sold in the future. The second tax consideration is the stamp duty land tax. As we said earlier, you will effectively be selling the properties that you have at the moment to the new structure, the new limited company that you've set up. That process, of course, it's a transaction of a property, so it attracts stamp duty. But yet again, there are solutions for this problem. As you incorporate, your existing arrangement, which could be a sole trader or a partnership, as long as you incorporate what's referred to as the whole business, so everything about it gets incorporated, then that process allows you to avoid paying the stamp duty. Therefore, I would say that under 99% of cases, it is worthwhile incorporating. Don't let the stamp duty and the capital gains tax put you off. Yes, you may experience some expense now with the upfront setup costs, but over the long term, the benefits should easily outweigh these. Okay, so you've decided that incorporation is the right move for you as a landlord. You now need to be aware that there are two ways to go about this. Now, in 2020 alone, more than 40,000 new buy-to-let businesses were set up. Unfortunately, the majority were not set up correctly. It would appear that most landlords setting those businesses up went about it with tunnel vision. They had sort of one end goal in mind, which was to mitigate the damage that the introduction of section 24 had done to their profits. They had the sole purpose of incorporating so that they could reinstate the ability to offset their mortgage interests against their rental profits. And that's fine, that's absolutely the right thing to do, and it's a damn good reason for doing it. However, it's not forward thinking enough, and some great opportunities have been missed. This is understandable. It's so easy to go online, set yourself up with a bog standard off-the-shelf buy-to-let limited company. It costs next to nothing to do it, and there's really no need to take any professional advice. However, that lack of professional advice at this stage is where people are going wrong. Consider this. Think of some of the big companies out there, the likes of Richard Branson, for example. Do you think he sets his companies up with a bog standard, off-the-shelf, limited company structure? Of course not. But remember, the same set of tax rules and same opportunities to be smart about it are available to you as you set up your limited company. So if you're smart from day one and get the setup right by spending just enough money to get the proper advice that you need, then your limited company structure will easily pay for itself many times over in the future. Yet again, it's a case that not one size fits all, but the example I'm about to give, you should be able to see how if you tweak it and manipulate it slightly, it can be made to fit your circumstances. And for this example, don't pay too much attention to the sums of money allocated to the shares, the share allocation itself. These can all be changed to suit your requirements. Of course, you're going to take some professional advice anyway. This could be an example of a suitable fit for a family-run business. Let's assume that mum and dad are happily married and they're setting up the limited buy-to-let business with the children's future in mind. The new business may require an initial investment to operate. So mum and dad decide to loan the new limited company a sum of money by way of a director's loan. This loan, of course, is for the purpose of buying buy-to-let property. It may be enough for the initial deposit on the first property. Now, this is the first opportunity to be smart. Let's assume that mum and dad decide to charge the business an interest rate for the loan. Let's also assume that mum is a basic rate taxpayer. So it therefore makes sense for the loan to be perceived to be coming from mum. Therefore, the interest charged to the business for the loan is repaid to mum. She then pays income tax on that interest at her basic rate. This interest payment for the loan is a business expense for the company and can be used to offset the profits. Okay, let's take a look at the actual example and explain why things have been structured the way they have. Remember, we have a family-run business here where the primary objective of mum and dad may be to receive their interest payment on the loan that they've made and probably receive some dividends as well. But at the same time, the consideration is for the next generation and for inheritance tax planning. So here we have an example of a limited company with a share structure that would work particularly well for a family business. As you can see, we have dad, mum, son, daughter. We've also got two additional categories, which is grandparent and discretionary trust, which we'll come back to later. For this example, dad is a higher rate taxpayer, everyone else is basic rate. We'll use dad as an example here. So as you can see, he's been allocated share class A and also what's known as freezer shares. We'll come back to that as well. So you can see he's been issued with effectively 95% of the business. His class of shares qualify for voting rights, dividend rights, but no growth rights. Now, the reason for no growth rights, as you can see, everybody in the share structure has no growth rights apart from this discretionary trust. That links back to these freezer shares. So what that means is that when the shares were issued, ideally from the inception of the business from day one, everyone's value in the business, so their share value, was frozen at that point in time. So we'll use Dad as an example here. So his total share value was frozen at £95. Then no matter how much the business grows in value, his share value will never increase. The benefit of that is that should Dad in the future wish to gift his shares to son or daughter or both, then he will be gifting them at the original price of £95. So no matter how much the business has grown, his shares will still be of the same value, will have seen no growth. Therefore, there will be no capital gains liability on that gift of shares. Now, as you can see, dad, mum, son, daughter, they've all been issued with the same share rights and responsibilities. Again, it's a family business, possibly a good idea so that everyone feels sort of included and actually part of the business. So if we now quickly look at the grandparent, basic rate taxpayer issued with Class E freezer shares. So again, their share value will never increase. Also slightly different rights and responsibilities. No voting rights because they're not effectively involved with the day-to-day running of the business, but yes for dividend rights. Now, the reason and the benefit of this here is that should Dad wished to issue some additional dividends, but not to himself because he's a higher rate taxpayer, then he could issue shares to the grandparent, let's say £10,000 to grandma, and then should she decide to spend that dividend money on her grandchildren, then that's entirely her decision. But she's been able to have that dividend issued to her at a basic rate of tax. Now, the final thing to notice is the discretionary trust, and that ties the share structure all together. This is where the growth in the business is actually allocated. So all the other shareholders have had their share value frozen at that point in time, or ideally from day one. So any growth in the business has to go somewhere, and that's been allocated to this discretionary trust. This discretionary trust is out of mum and dad's estate, so therefore any growth in the business will grow with no inheritance tax liability. The discretionary trust can then loan money to its beneficiaries, and the beneficiaries can be son or daughter. Okay, so let's now visualize this exact same example in a slightly different way. So here we have the same limited company set up as a family business with the alphabet share structure for all the shareholders, freezer shares. So their share value has been frozen from day one and will never increase in value. We've got the growth shares allocated to the trust fund. So as the business grows in value, that's where the growth will be allocated. So here we are 1 year later, and the business has grown in value. All that growth has gone into the trust fund, and the shareholders' share value hasn't changed because it was frozen from day one. So here we are in year 5. The business has continued to grow in value. All that growth has continued to go into the trust fund. The shareholders' share value, again, it hasn't increased in value at all. So for our example of dad wanting to gift his shares at a later date to son and daughter, for example, well, his share value hasn't seen any growth, any capital appreciation, so he would be able to gift those shares at the exact same value as what they were on day one, and therefore there would be no capital gains liability. And because the trust is out of mum and dad's estate, then all the growth in the business would be exempt from inheritance tax. Then the trust, for example, can loan money to its beneficiaries, and the beneficiaries can be son and daughter. Let's now look at an example of a off-the-shelf limited company with an ordinary share structure. No grandparent, for example, for the benefit of dividends, and no trust fund for the allocation of the growth in the value of the business. And it's also not possible to freeze the value of the shareholders' shares. So they will, in theory, grow in line with the value of the business. Now, if, for example, we skip forward 10 years and assume that the business has doubled in value, then in theory, the value of the shareholders' shares will also have doubled because it wasn't possible to freeze them from day one. So for our example of dad wanting to gift his shares at a later date to son and daughter, well, because they've doubled in value, they've seen a capital gain, and in order to then transfer them or gift them, that capital gain would have to be realised and is now taxable. And because the value of the business has grown with the shareholders and not in a trust fund, that growth forms part of mum and dad's estate and is therefore subject to inheritance tax. So there we go. That's one example of how it can pay to be more forward-thinking with the structure of your limited buy-to-let business. Hopefully you can see how this example could be tweaked to suit your circumstances, and clearly it's quite a bit more complicated than a bog standard limited company with a ordinary share structure. Definitely worth some professional advice from a specialist. Speak to your accountant, they may be able to help you with this, but you'll probably need some more specialist assistance. Thank you for watching. If you could hit the like and subscribe, that would be much appreciated, and I will be back again soon with another video. Thank you.